Hey, good afternoon. How's everybody?
Yeah, doing
Hello.
good.
Oh, okay.
Good
Good.
afternoon.
How are you making? Hey, DeAndre. How are you? All right. So let's see.
Good afternoon, Professor.
Hey, good afternoon, Sora. How are you? All
Okay.
righty. Good. All right. So let me. I'm sharing my screen now. So let me just go to first check. I have 8 people here, and then in the let me check the discussion board. How many people are there? Oh, I think I was there a while ago. Discussion board. Okay, looks like I have also 8 people here. Okay, and then you may have noticed I just today uh, there was an instruction about the not the midterm, right? It was just posted today. I hope you all got it. Did you get it?
Yep. Mhm.
Yes.
Okay, so you have this weekend for it. Okay, and this covers basically 2 topics: financial statements and time value of money. Okay, um, and so it's not. It's going to be visible from 12 a.m. tomorrow, right? It's not there yet. I mean, it's there already. Actually, it's just not visible, right? It's going to be there. All righty. So yesterday we did. We finished the amortization schedule, right? And the amortization in in my old video, I mean, because the original the video pre-recorded videos were made like about 2 years ago, right? Because when this whole thing started, pandemic started, and we all in March, I believe in March, sometime in March, the school started, school went into lockdown. So from that day on, and so in March, nobody was prepared, but we had, Blackboard. We've been using Blackboard for many years, for almost at least 2 decades. So, and then there was Zoom, and so we started. We were just thrown into just like when you're a kid, the best way to learn swim, they always say, they just throw you into the water, dump you into the water, let you just paddle and get you out of the water. Just like that, we were thrown into Blackboard, and then at that point, I was starting to record. Oh, at that point, so that was spring semester of 2020. At that point, at that time, I didn't record anything. It was just synchronous, faced online every day. But then from then I realized, I mean, uh, I put in a lot of effort in doing giving the lecture, and if I do it just leaving it just ephemeral like that, transient, after the class is over, it's gone. So over the summer, I recorded, uh, actually pre-recorded before. Uh, no, for summer session, and mainly for fall, and then so the reason I'm talking about this is when I recorded that video, uh, the amortization schedule was a little different. So what you see on that pre-recorded video, you may notice that I didn't put beginning principal balance at the time. And then it was not necessary because all you needed was, you didn't need, this column, but, it could be all done by 3 columns. But then I just realized that it would be more intuitive to the students if you have beginning balance, because when you have the beginning balance, yeah, at time 0, right? What time 0 is the beginning of the first month, right? At time 0, of course, the entire principal is the balance you're facing. So it makes more intuitive. And then at the end, ending balance, and then that is carried over to the beginning of the next month. And in most other models, like depreciation model, especially the depreciation schedule, you have beginning balance and ending balance, and that is more common to do it that way. So that's why I added the beginning balance column in this model, right? So some people may wonder, oh, what I saw in the YouTube, or what I saw in the original pre-recorded video, it's a little different. It's a little different, but it's basically the same thing, right? Beginning balance is the only thing that has been added, and eventually the conclusion is the same conclusion, right? At the end of the loan term, right? At the end of the so at terminal time, ending balance must be 0 exactly. The sum of all the principal paid must exactly add up to. I mean, that's what sum means, right? It sums to the original principal, right? That has been all paid over, 60 months. And then the total payment, sum of all the payments, must be equal to interest paid and principal paid. And it is exactly. I mean, by sum command, right? I already have here, it's automatic, right? And then with the sum command, all the interest paid, we know that's 3,000. And basically, if you add this to this, that's exactly this, right? So everything checks out, right? This way, it's impeccable. I mean, our model is, impeccable. And you might think, oh, yeah, well, that's nifty. I mean, that's cool. That's clever. But how often will I use this? I mean, will I? And even if I use this, I mean, how tedious? I mean, it will take a lot of. I mean, it's not going to be tedious once you know how to do this. It's because it's at a snap of a finger or click of a mouse. But the thing is, but it will still take me time to build this. No, it won't take more than like 2 minutes, right? All you need to do is first think about it. And when do you use this? In your life, there will be at least like 4 occasions where you would need to borrow money, right? What are those occasions? 1, student loan. Okay, you don't need student loan. I had, I didn't get a student loan. I could pay for it. I worked, and I paid my way through college. Okay, good. But if you get a student loan, okay, the first, second, car loan, you will get, right, when you, just like this, when you buy a car, you will need. Okay, but once again, you say, oh, I don't need I can just pay for the car out of my own pocket. But once again, what is the point of financing? Not because you cannot afford to pay the full amount in lump sum cash, but because, for example, here in this example, your interest rate is 6%, right? But what if, and you borrowed 24,000, but what if you had 24,000? If you already have 24,000 with a down payment, that's 30,000. You would just, you might say, oh, I'll just pay cash, 30,000 cash. But again, think about it. If you finance it, you borrow 24,000, and that borrowed money is, paying basically, first that goes to the bank, right? Because you pay the bank with the borrowed money, that's why they will release. Not the bank, but the car company. I'm sorry. You borrow that 24K from the bank and pay the car company. So that's why you get the car key and drive it out. And then through over 60 months, you will pay the bank, right? And the reason you're doing that is because what if this 24,000, you already have 24,000, you just didn't use that 24,000 of your own money to pay for it. Why? What if you had an opportunity to invest this 24,000 and earn 12% a year? If you had such an investment opportunity, wouldn't it be better to finance it? Finance the car. In other words, because if you finance the car, you borrow 24K and then you pay only 6% a year, whereas your own 24K is invested and it returns 12% a year. In other words, that 12% is already paying for that 6% interest, your financing cost, and then still leaves you with 6%, right? If that's the case, it definitely makes sense to finance the car, right? Even if you had $30,000 in cash, right? So that's the idea behind it. Two, so by financing it, then now it is the amortization schedule. So how does once you get the hang of it, it just takes 2 minutes. First, you'll have to build this. You'll have to calculate the payment, and then once building this may take if you're really if you get the hang of it, if you're used to it, but this can take probably 30 seconds. And after that, building this, it only takes the first row. Isn't that right? It only takes the first row or the first 2 rows, and then drag it down, right? And once you drag it down, then it takes probably it's another 30 seconds probably. But the whole thing won't take more than 1 minute to 2 minutes, right? Once you get the hang of it. And then the benefit is, and then because it shows you how the monthly payment breaks down, right? It breaks down to interest and principal. And as you can see, early on, you pay the most interest, but the interest will get smaller and smaller and smaller as time goes on, smaller and smaller and smaller. Why? Of course, because the principal balance is getting smaller and smaller and smaller as you make the principal payment, right? So, where did I put the? I should. Where did it go? And as the saying amortization goes, it will show exactly that decaying pattern. Whereas you see this is the principal balance. It shows exactly that decaying pattern, right? And as you look at principal balance, how it goes down, it's showing the decaying pattern, right? Uh, and the because payment consists of interest paid and principal paid, as interest paid gets smaller, then principal paid gets bigger. And the more, and so think about it, beginning balance is dropping, showing that decaying pattern. In other words, as time goes on, it will drop faster because the principal paid gets, as principal paid gets bigger, right? Um, the principal balance gets smaller, right? So it shows you how it breaks down. And another thing is, so you've been paying, you've been making monthly payments, but now around month 11, right? Around month 11 or month 12, you came by a large sum of money. You won the lottery, or um, someone in your family left an inheritance or bequest or whatever you call it. Uh, there was an uncle you never knew, and the uncle had no other, immediate family. So, as a nephew or niece, you are the most, immediate family. So, the uncle left you at least, something like uh, $500,000 or something. Wow. If it is $1 million, the better. Anyway, you came by a large sum of money. Then, you can think about paying it off, right? Uh, you're tired of, making monthly payments, so you want to pay it off. Um, and then you want to know what is the payoff amount. So this tells you what is the payoff amount because the remaining principal balance is exactly the payoff amount. That's remaining principal balance. As long as you pay it off, then you're done. Uh, of course, in reality, there will be some, fees, some transaction cost. The bank will have to do paperwork, uh, release the title, and things like that. So there will be some transaction cost. That won't be more than $20-$30, right? Pretty much, this is all. All you need to do is, just add about $20-$30, to this, and that will be the actual payoff amount, right? So that's something, that's the benefit of the amortization schedule, right? But but besides all that, I mean, even before that, being able to do this is a very cool thing, isn't it, right? Being able to do this on your own, and within 2 minutes. That's a very cool thing, right? Okay, so that's the amortization schedule. So the last topic in the time value of money is APY, or effective interest rate, or effective annual rate, right? So what is effective interest rate? Now think about it. We all know, let's go to this bottom tab, and if you open it, you will see this section, I mean, this area is completely blank. It should be, right? Is it blank?
Yeah. Yeah.
Okay, good, good. And you might not see columns F, G, H. You may not, but it's because it was hidden, right? I deliberately closed or collapsed those columns. You can open it just by double clicking here, double clicking on the first, double click here, and then it will expand, double click, expand, double click, expand, right? Um, and this is, you understand what this is. Oh, it's the same scenario, 10,000, 6%, 5 years, but different compounding frequency. Normally we have 1, 2, 4, 12, 52, 30, 365. 52 we generally don't use, but there's annual, that's annual compounding, semi-annual, quarterly, monthly, weekly, daily. But then we already know that the greater the compounding frequency, the greater the future value. We already know that, right?
Yeah.
Even yeah, although the APR is the same, principal is the same, right? Time is the same. Well, we can simply do the experiment, right? I mean, oops. We know periodic rate is like n is t times n. And then future value is, of course, p times. What's happening? What? I didn't. This is. This Chromebook is, really something. P times 1 plus r, right? Raised to n. And then we can just drag it down to, to the bottom. But just don't drag it down all the way to row 14, because in row 14 it is, infinity. So we need to use a different, yeah, it was already filled in. So, and it shows you, right? It shows you the future values, and you can tell. I mean, this is the proof that the higher the compounding frequency, the greater the future value. But interesting thing is, it doesn't go up that much. It doesn't increase that much after after daily compounding. It's almost just a few cents. I mean about 20 cents. But then after 10,000, right? After m of 10,000, then it's pretty much practically, of course, if I increase decimals from the third, fourth, fifth decimal places, there will be difference, but that difference is very insignificant. I mean, think about it. This is dollars, money, right? Even if there's a difference in the third decimal place, what difference does it make? I mean, it's still, 59 cents. I mean, at best, if it is rounded up, is 60 cents. It's not really. So in other words, this proves the concept of the exponential function, or Euler's number, because the Euler's number is what Euler's number is what explains, basically 1 plus APR over infinity, 1 plus 1 over infinity raised to infinity. In other words, Euler's number is basically, taking you to extending our the spectrum of time, and if we are tracking time, the continuous time can be only emulated by or simulated by infinitesimal fragments of time, and by connecting them, right? By connecting those dots. I mean, if you're connecting, dots, and if the dots are 1 year apart, obviously it won't be very smooth. But if, right, the natural, think about it. Another example I can use is, let's say you're filling the tub by running, the tap water. You open the tap water, and the water is pouring into the bathtub continuously. It's not like, so let's say we have a very giant tub. So, it takes 24 hours. It takes 24 hours to fill that tub, right? And if you're measuring the water level in the tub, water level of the tub, every hour, then the graph won't be a very smooth one, right? Because you're checking it every hour by discrete time. So the water level would be very discretely different, right? So if you connect those dots, then it won't be a smooth curve, but it will be a you can understand. We'll have a lot of kinks, but it's because you are measuring it at discrete time, like 1 hour apart. But if you're checking it every second, it will be smoother, right? If you connect those dots second by second, it will be smoother. And if you break it down into 1/1,000,000th of a second, it will be much smoother. But that's the reason why we are raising everything to raising m to infinity. And then but the point is, look, after the 10,000, these numbers don't get much bigger. They all tend, or they all tend toward one number, right? And that is 2.718 something. I mean, if m is if APR is in 1, in other words, 100%. But of course, to get the just the net, right? Just the net growth rate, you also have to subtract 1. So think about it. Then the idea is, what if we don't use this higher m, without using higher m, right? Higher frequency, but just so if m is 1, just annual compounding, what kind of annual interest rate will take us to the same future value? What kind of annual interest rate will take us to the same future value? You understand? In other words, here APR is all 6%, right? But the reason that the future values are greater than this is because of higher compounding frequency. So if we don't use higher compounding frequency, but if it is still 1, if 1, 1, 1, if m is 1 through and through, what kind of rate, what kind of APR will take us to the same future values like this? Okay? Now, that is called effective interest rate. And then how do you, so in other words, think about it. Effective interest rate when, m is 1, it's the same thing. But when m is 2, effective, so how do you find m? It's this, exactly this. Effective interest rate, and it is here also, right? Effective, this is a symbol for effective interest rate, effective rate, R star, 1 plus APR over m raised to m minus 1. It goes by many different names. Effective interest rate, so EIR, or effective annual rate, so EAR, or annual percentage yield, annual percentage yield. This is a term that is quite often used in the banking industry. Also sometimes AER, what is annual effective rate? So it's the opposite of EAR, annual effective rate. Goes by many different names. But then think about it. So we can find out. So using that formula, right, which is 1 plus, actually 1 plus APR over m is already done, raised to m. What is that? This is already 1 plus APR over m, isn't it? Oh, no. That's just APR divided by m. So actually, 1 plus, this is already APR divided by m. Isn't that right? Then raised to m minus 1. Okay? Because effective interest rate is exactly this. Okay? 1 plus APR over m raised to m minus 1. In column I deliberately put 1 for APR because if APR is 1, what does that mean? 100%, 100% return. So that means doubling your principal every year, right? But here APR is not 1, it percentage, 6%, and APR divided by m is already done here. This is already APR divided by m, isn't it right? It's already APR. A periodic rate is already APR divided. So that's 6%. But if you drag it down, you will see, right? So what does that mean? Okay, that means if compounding is not semi-annual, but annual, if compounding is annual, what kind of rate, what kind of APR will take you to this future value, right? Then is the APR, this 6.09 is the APR that will take you there with just single compounding, with just annual compounding. And 6.136% APR will take you there by just single compounding, right? Not multiple, not this, numerous compoundings. Also, 6.168% APR will take you to this by single compounding, not by monthly compounding, and so on. And so that's APY. That's called annual percentage yield or effective interest rate. Again, so effective interest rate is what you hear quite often if you put your money into CD, right? Let's say you go to a bank and asking, okay, what's your CD rate? They will say it's 1.75, but 1.89 APY. Okay, then what does that mean? Oh, there's the compounding frequency is more than annual, because if compounding frequency is annual, there's no difference between APR and APY, right? But if there's a difference, there's compounding frequency is more than one, then there will be a difference, right, between APR and APY. So you can do it, in reverse. I mean, you can find from APR, you can find APY. But if APY is known, you can do the reverse engineering. You can solve it backwards and get to APR as well, right? It's not, not a very difficult thing. It's just algebra. So the question is then, how do we do? Okay, one thing you may have noticed that, oh, then APY isn't that much different from like 10,000 M, being 10,000 M, compounding frequency being 10,000, right? Yeah, it isn't that much different. And I already said that when, with the future value, if you really want to see the difference, let's try increasing, okay, all together. Let's try increasing decimals by many digits, okay? Now it looks, when these things happen, I told you it's because the column width is not, wide enough. So to see the difference here, we already see the difference right here. Although so maybe I don't need to go that far. It's just about already it's so from here it shows difference. So I'm gonna just take it back one, right? But that difference is just insignificant. And this is not dollars. Actually, something's wrong. It's not dollars. It should be a percentage, right? So I'll just go to a percentage. And then I'll give it like, 3, 4. Okay. So the difference after this level, right, is not really, that significant. They all gravitate towards like 6.18 something, because basically Euler's number. That's why Euler's number is the ultimate limit, right? That all these numbers converge to, converge, right? And this row is what? This row is when the compounding frequency is infinity. So then, how do you calculate infinity? I mean, how do you find the future value and APY in that case? Future value, right? When compounding is continuous. I don't know why I didn't put it here, or where is it going to be? Okay, looks like I didn't. Oh, here. Future value when compounding is continuous. Again, at this point, you may not understand, or you may not really realize how important that continuous time is. But in science and engineering, continuous time is a very important thing, because that's the reality. And you cannot you cannot, uh, you cannot exactly track the trajectory of a missile or rocket, right? Without following it or tracking it with continuous time, because discrete time will give, obviously, because there are kinks in the uh, discrete time, and the accurate tracing of or tracking of the trajectory is a very important point, because it's an important thing. For example, if the space shuttle, before the days of space, in 1969, Apollo 11 landed on the moon. But when they return to Earth, they have to enter the Earth's orbit, and when they enter the Earth's orbit, if that minute miscalculation in the angle can bounce the spacecraft out of the Earth's gravitational field, and then they will be lost in the space forever, right? Unless the Kennedy Center, NASA sends off another recovery vehicle. But at the time, 1969, they didn't have that kind of technology and capability. Now they may be able to do that. But if you've seen the movie Interstellar or Martian, even trying to send the rescue, the first the exploration team got stranded on Mars, and only was that Matt Damon survived. But then from the Earth, to dispatch a recovery team or rescue team, it will take a lot of time, right? And in that movie, Martian, he Matt Damon survived, miraculously. But in 1969, if they are stranded in the space, then they will just die, right? No way to so think about it. If you cannot track the trajectory accurately, right, then re-entry into the Earth's gravitational field, and it will be all it will be a disaster. So continuous time, being able to track anything, or by continuous time, is what sets the moon science apart from, right? And then, if you are a liberal arts major, or humanities major, you will never have a chance to even hear about Euler's number or continuous time. But if you're a science and engineering major, you will hear continuous time and Euler's number over and over and over, and you will know, oh, what is the connection between, you know. So this was a funny skit from, I think, it was a funny picture skit taken from internet years ago, and it was in South Korea, some university, the School of Engineering, the students in some School of Engineering, they put out a banner. Actually, that was like a mocking, or I don't know if this is working today. I don't know. This is not working today. I don't know why. It's totally not working. And the whiteboard is totally not working, so I'll have to go to this. So they put up a banner in the campus, and they were like, because they were, I think they felt, they were disgusted by some, philosophy majors, always pretending to be so wise, but actually not being able to solve any real problems. Philosophy cannot solve any real problem. It's just, isn't that right? But philosophy majors, or so-called philosophers, are as if behaving as if they are very wise men. So they put the School of Engineering, they put out a banner. So liberal arts majors, hey, liberal arts majors, have you figured out yet what is natural log of E? Right? Think about it. Now you know what it is, right? And if you wonder, try it. It's 1. Why? Think about it. It's like log 10 of 10. Isn't that right? Because natural log is log. Where is the undo? Because natural log is log of E to base E. I mean, natural log is log to base. And if you're taking log of Euler's number to base E, it has to be 1. Although the answer now is simple and straightforward, but until you understand this, right? All that time and effort you have to put into that, all that, brain, I mean, the torturous cerebral torture, time of cerebral torture to crack this. It has taken, I'm sure, this is something you would have never expected to, I mean, if you have just taken Business 104 or Marketing 100, you'll just, oh, how difficult can it be? I mean, business is business. Look, there's a whole different world, in other words, if you're a science and engineering major, what sets you apart is something like this: the understanding of continuous time, understanding of Euler's number, why Euler's number is needed, and why history major or sociology major will never Of course, if they study this, they will know, but they hardly study something like this. Of course, this was they were trying to make, mock or make fun of the probably the philosophy majors. But so that's the importance of the continuous time and the Euler's number. And so if compounding frequency is infinity, then we have to use Euler's number, and then the future value, the formula for future value is like this: principal times e or exponential function, that's another name is exponential function, raised to r times t. But in Excel, exponential function e is like this. And although it's raising to power, when you use this operator, you put that in the parentheses like this. Okay, so the future value, I got it like this. Principal times exponential function, and in there, r times t, right? And I got to this. Of course, if you want to increase decimal, you will see. Yeah, it's not really significant difference after like 10,000, because below cent, I mean below a dollar, I mean we use only 2 decimals, right? I mean you cannot 58 cents. They are all like 58 cents, so almost if you round it up 59 cents. But because we had $10,000, what if our principal was $1 million? What if our principal was $1 million, right? It will be pushed by 3 more zeros, 3 more digits, and it will be a different story. I mean, it will be, right? And then APY, how do you find APY?
Professor,
that was already
sorry.
Yeah.
Could you, your screen really wasn't visible, at least on my end, when you just structured that last equation. Could you show that in the Excel sheet again, please?
Oh, yeah.
Oh, could you explain it? I didn't really use.
Okay. But let me finish this first. Okay. Let me finish. So then finding APY. You don't just like, look, APY was 1 plus APR over m raised to m minus 1. So you don't need principal. Just only because APY is that factor. I mean, if I borrow the I don't like interest factor table because that was like 19th century method. But the way the factor, how they calculate the factor is just a compounding factor. Is that part 1 plus r raised to n part, right? So basically what you need to do is e raised to r minus 1. In other words, so by doing that, you get to this. That's the APY. Now to the point of the question. So again, did you see this? Can you see this PDF file? Who asked the question?
Yeah.
Yes.
Yeah. So this is the formula for future value, the compounding formula when time is continuous, right? In other words, when we use continuous compounding, right? So it's principal times exponential function, Euler's number, in other words, raised to r times t. Again, in Excel, that Euler's number is a function that is entered this way. So you have to use EXP, and in the parentheses, you put, R times T, which is, so that is being raised actually. That's how it is done in Excel. So so that's what I did there, and also so here, effective rate when M is continuous, right? Okay. Now here, so back here, so actually this thing is not necessary. I'm gonna tell you later, because I just for fun I put it there. It's not. So then column I. Let's think about what column I is. It's exactly how Euler's number is derived. In other words, when and Euler's number is what? It's basically 1 plus 1 over infinity raised to infinity. Now, minus 1 is just something I put there later to make it APY. But Euler's number, if we are going by, if you do Euler's number, if you just get, and then to get to Euler's number, we assume a return of 100%, right? And everybody understands 1 is 100%, isn't that right? So if you're, if you can, that means 1 year later you double money. But so first, it's 1 plus 1 over m raised to m. Then it's just 2. It will give you 2 because it's doubling the money, right? And then if you drag it down, so, but what if the compounding frequency is, okay, what if the compounding frequency is, yeah. And to see the difference, but then by the time you get to like, m of 10,000, you are almost there. You are almost close to the Euler's number. And here, this is Euler's number, right? E raised to 1. In other words, E raised to 1 is E, right? E is self. You see, that's Euler's number. And then, so this is pretty, pretty much close. I said, 2.7181, Euler's number, as I said, 2.7181 something something. It's actually 2.718281. But by the time you compounding frequency is 10,000, it becomes pretty close. So that's why all those results converge to Euler's number, right? As you increase the compounding frequency, they all converge to Euler's number. So that's the ultimate limit, right? You might, and if we subtract 1 from that, if we subtract 1, because this is gross return, right? Think about it. If you had $10,000, and if the interest rate was 100%, 1 year later, it would be $20,000. So this 2 is gross return, not the net return. To find the net return, you will have to subtract 1, because 1 is itself. 1 is the principal itself, right? Subtract 1, then everything will be, 1, 1.25, 1 point something something. So this is basically, the explanation of APY, or effective interest rate. Now, when you go to the bank to buy CD, or to get a loan, you can ask them, um, what is the APY? And if they tell you, you can tell, oh, if the APY is different, if they give you the same APY as APR, you don't put your money there because they don't, give you, uh, uh, they don't compound it, you know, uh, they just compound it once a year. But unless they give a clearly superior rate than other banks, but then the other banks, banking is a very competitive industry. Other banks' rate would be not that much different. But if the rates are not, APRs are not different, it's the compounding frequency that would make the difference. So obviously, the one that gives you the highest APY, APR won't be that different because the industry itself is very competitive. But APY, highest APY, that's the one you need to go with. And then if you are getting a loan, right? Again, if you are getting a loan, you have to check what the APY is. If they're obviously, as the borrower, you would want the APY, you would want the one loan to have the smallest APY, right? Makes sense. All righty. So I think it's a good time to take a break now. It's 7:07. Okay. So that wraps up everything about the time value of money. And then, so we'll take a 10-minute break. And when we reconvene at, 10 minutes later, so that will be about, 7:20, then we are going to start on the bond valuation. Okay. We're getting into a new topic. All righty. So let's take a 10-minute. Okay. All right, we're back. We're back. So now we're moving on to the. Okay, where is it? We're moving on to bond valuation, and you will see the reason we've done this time value of money is to be able to do the pricing or the valuation of bonds and stocks. So first, with the bonds. But I must have downloaded that file before. Oh, I don't seem to be able to find it. So I'll just download it again, or I can. Uh, so I can also open it from course materials, and then topic for bond valuation. Okay. You will need to also download the Excel file. Let me download first. Just going to open it like this. I'm going to, okay, I think I cannot do it like this. Okay. Okay. All right. So we already know the bond basics, right? We already know that the bond is a debt instrument, right? Standardized debt instrument issued by either federal government or local government, municipal governments, state and municipal governments, um, and also by corporations, right? Then how are the bonds quoted uh, in the print media? Oh, I forgot. I forgot to put on the headset. I mean, maybe you guys could hear me, but if even if anybody was speaking to me, I could. Um, so in the print media, right, and also in the online, they do not have to do it exact like this because but this is basically the convention when they report bond price. This is the convention, so uh, it will be pretty much like uh, the print media. So there are three types of bonds, right? Represented here, three types of bonds. One is the treasury, right? Second one is a corporate bond, and it's a CIT group. I think CIT group is something like insurance company. And then there's a municipal bond, so issued by New York City Municipal Water Finance Authority. Um, and then, so that's the first column, and the first column is usually the entity, name of the entity that issued the bonds, that sold the bond. But in case of Treasury, it shows coupon rate first. And what's the coupon rate? And in the bond basics, we already talked about it. Coupon rate is the interest rate that the bond pays. It's called coupon. The interest that the bond pays is called coupon because um, you don't see it anymore. It's not like that anymore. But in the old days, the bonds, uh, Okay, bond quotes. Okay, I don't know where I put that picture, but we can just do the internet search. In the old days, the bonds came with coupons. That means, I don't know if they do that anymore, but in the because even until early 2000s, the students were doing that. There's a message board everywhere, right? In the campus, message board, or where you post something with the push pin, right? And then you can still see they post something in the that message board, like if there's a yard sale or garage sale, they post it in the message board, and then with the telephone number at the bottom. In other words, maybe it's easier to draw it. And even in the early 2000s, the students used to sell their book. I mean, when the semester's over, they are done with that course, then they were selling the book, right? And then, oh, that's already open. So, okay. So basically, in the message board, book sale. And then, let's say, finance 100, right? You put $100. I used books, but and then econ 201, $90, or and then at the bottom, they cut it like this, and this is called what do they call this? Chat, or because back in 2000 election, Al Gore lost to George Bush, and there was a little issue in Florida, because in Florida ballot there was something like Florida ballot had something called CHAP or something, but anyway, which had not exactly aligned punch holes, so that caused recounting of the votes and something like that. But anyway, so they cut it like this, and so what should this be called? They put their phone numbers. So if you are interested in buying this book, call this number. They put phone numbers, right? And so if you're interested in that book, you cut one, right? So that's the idea. In the old days, the bond came like this. Bond came with coupons like this. So coupon was like a voucher, sort of like you can exchange it with the interest payment, right? So a bond, let's say 10-year bond, right? If it is a 10-year bond, 10-year bond came with like 20 coupons like this, 20 coupons. Each coupon was cut out every 6 months, and then you present it to the bank, right? Or present it to the, if it is a corporation, company bond, you present it to the company or the bank that the company designated, You present it there. You receive the interest. So that's why it's called coupon. Okay. So the first in the first column you see coupon rate, and then the coupon rate is 2.75. And in the second column, maturity, right? February 2013 is the maturity. Okay, and at the end, I will come back to that later. Now, but corporate bond and municipal bond in the second column, they give you a coupon rate, 7%, 4.5%. So that means, all the bonds have face value of 1,000, right? So, I mean, 2.75% is annually $27.50 because the face value is 1,000. A CIT group, annually $70. But they pay interest twice a year. So in other words, bonds are on M for the bond is semi-annual. M for the bond is 2. Understand? Right? Compounding frequency for bond is 2, semi-annual. Coupons paid every 6 months. So they will get, $30, $35, right? Annually 7%. So semi-annual 3.5, so $35, right? Every 6 months. Maturity is May 2016. Muni bond, municipal bond. Now, muni bond is the only type of bond whose face value is not 1,000. And what's the face value? What's the face value of a muni bond? Anybody? What's the face value of the municipal bond? Does anyone know that? Anyone? Or is anyone there? Is anyone home?
I just don't know.
Okay.
Yeah, me neither.
Oh, okay. Okay, you can check it out. But I will tell you. I mean, you can check it out, but I will tell you. 5,000. Municipal bonds have face value of 5,000. Okay.
Does that represent the minimum for it? Minimum,
Minimum.
like what does that
Face.
represent?
That's the face value, meaning that's the maturity value, par value or maturity value. Okay. In topic 1, we did some bond basics. We already, you add maturity. If you buy bond, let's say if the bond has 10 years left maturity, right? You may pay. Most likely, you will pay less than $1,000, less than the par value or the maturity value, right? And and until the maturity, so over 10 years, you get coupon interest every 6 months, and at maturity, you will get the face value or par value or maturity value of 1,000, right? You forgot already? We talked about this extensively in
No,
topic
I know
1.
that. I just didn't know municipal specifically.
Oh, municipal city. If you municipal parking, what does that mean? Municipal parking, the parking lot that is parking lot that is operated by the municipality, the city, right? If you go to Queens, if you go to Queens, I don't know. New York City, I don't know if Manhattan has municipal parking because I haven't seen. In Manhattan, it's all privately owned parking, so you have to pay, right? Parking lots are operated, parking structures are operated by private companies. But if you go to Queens, what street was that? Union Street or Main and Union, or there is no municipal parking. Of course, it's operated by the city. Of course, you have to pay. Of course, it's not for free. Okay, municipal means city, municipalities. So that's why I told you it was issued by New York City Municipal Water Finance Authority. What does that mean? That must be some city governments, New York City government's department that that has to do with the water supply, right? Maintaining the aqueduct and developing new or if the the water supply from New York City comes all the way from like where Poughkeepsie or Albany or Poughkeepsie, and it runs. They have huge pipeline that runs underground from the water source, and that a huge concrete pipe is pretty much like 10-20 feet in diameter, I guess. I don't know if you guys ever saw the movie, Die Hard, Die Hard 2 or Die Hard 3. In that movie, Die Hard, I don't know if it was Die Hard 2 or Die Hard 3. Bruce Willis is a New York City cop, and I guess in Die Hard 1, it was, he was in LA. then he, uh, then, then some terrorist organization was uh, trying to raid the Federal Reserve in Lower Manhattan because in the movie that was 1980s movie, actually not 1980s but 90 something, 1983 or 1983. 1993, I guess, 1993. So you can, I don't know. It's always once in a while they always do the rerun on TV. I mean, some holidays, you can, but check it out on YouTube. What Die Hard 2 or Die Hard 3. So in that movie, basically they are distracting. Basically, they are trying to divert the attention of Bruce Willis, and they make it look like they're they're trying to blow up some elementary school in the Bronx, or in the meantime, what they were doing was they raided Federal Reserve in Lower Manhattan um, and take all the gold. I don't know if there's really gold in Federal Reserve, uh, but they basically it's a heist. So they put all the gold in, load all the gold in the construction truck, and of course it's covered, like construction. And this construction truck is headed towards uh, Albany or uh, Poughkeepsie or Albany, and it's taking. How do they get there? They take this aqueduct, right? Aqueduct. So aqueduct is basically a big, water tunnel or water pipe underground, and the diameter is almost like trucks can go through there. So the diameter is about 20 feet at least like 20 feet, because that's what because trucks can, I guess, go in 2 lanes there. And the height, because it's diameter, of course, you can stack up 2 trucks, two big construction trucks. I mean, that was the scenario, basically. I mean, that was the plot, and it was also a diversion by the terrorists, because they were actually, the real gold was actually shipped from New York Harbor. But I don't want to tell you the whole story of the movie, because the only reason I brought it up was because of the aqueduct. Obviously, New York City NYC Municipal Water Finance Authority is the obviously division of the New York City that deals with something like that, construction of the and maintenance of aqueducts, the water supply for New York City. Anyway, the muni bonds have the face value of $5,000. Okay, so if the coupon rate is 4.5%, it's not $45, but simply you can afford 5,000 times 0.045, and it will come to whatever, right? 5% of 5,000 would be $250, isn't that right? 5% of 5,000 is something like 250. So it would be something smaller than 250, right? But that's annual. So I've been telling you, bond is semi-annual. Bond is on semi-annual cycle. So coupon is paid every 6 months. So half of that will be the coupon payment. Now maturity, June 15th, 2037. So actually, if you wonder, the maturities are already, these 2 bonds, maturities are already passed, but this one still has maturity left. It still has outstanding, still an outstanding bond. So you might wonder, so when was this example taken? And I could trace it back. I mean, how? Because you can calculate n, and based on maturity and face value, you can trace it back to. I mean, calculating find n, and you can trace it back to when this example was taken. So, and according to my calculation, the examples were taken around June of 2010. So at that time, this treasury was still had about about 2 years, and it was February, so 2 years and 8 months left, or something like that, right? And then, so anyway, so that's the second column for other bonds. But second column for Treasury, but that is the third column for corporate bond and the muni bond. Now, third column for Treasury is the bid and ask price. Bid and ask. The price is the fourth column for other types of bonds. But interesting thing is, only Treasury is quoted in both bid and ask price. Other bonds, just it's all ask price basically. It's ask price. I mean, it's one because in the market, you understand what bid and ask is. Bid is the price that the buyer is willing to pay. Ask is the price that the seller wants. Seller asks for, right? Seller is asking for. Um, and most of the times, you have to pay if you bought anything on eBay, right? You have to pay the. Of course, if it is an auction, the highest bidder will win, right? But the buyer has the reserve price. That means that's the minimum price that the seller has the reserve price. That's the lowest, the minimum price that the seller wants. Of course, the bid will have to be above the reserve. But in most cases, if it is just a simple buy, buy now, buy right now, you have to pay the price that the seller wants, right? But then you might wonder if the seller is charging outrageous price, do I still have to pay for that? No, there are other sellers, right? You can do the comparison shopping, right? And it's easy. I mean, on eBay or on Amazon, you can do comparison shopping because you can search and then you can use filters, and with a lot of those sellers that meet those filters will be listed, and you can choose from them lowest price or the best price. But anyway, usually still, even if you find the best price that you want, still you have to pay that price. In other words, you pay the what the seller wants. And then interesting thing is, before let's take a look at the last price of the corporate bond. Okay, what does it say? 91.735, 91.735. Does that mean $91.73? Or even rounding, if it is rounded, 74 cents, does that mean $91? But if it is $91, isn't it a bit too unreasonable? Why? What's the face value of the bond? I told you the face value of the bond is 1,000. That's what you get at maturity. And how if this example was taken in June of 2010, that means maturity. They had only about 6 years left to maturity. So then, isn't that, if it was selling for $91, isn't that outrageously good price for the buyer? Because it's not even $100. You pay, even if you pay $100 in just over 6 years, you will get $1,000. So that's almost 900% return over 6 years. That doesn't seem right. I mean, obviously from the buyers standpoint, from the buyer's standpoint, there's nothing wrong. I mean, if it gives you a 900% return, that's 900% holding period return for holding it for holding period of 6 years. That's a great buy. Not only that, they are paying you $70 interest every year for the next 6 years. So how great it is if it is really like $91. I mean, if it is $100, right? Isn't it right? I mean, this is logical thinking, isn't it right? Don't take everything at face value. I mean, if you think, oh, the price is $91, oh, that must be well, that was the price quote in the print media, so that must be right. I mean, if you take it with no question, right, that means you don't have any critical thinking, right? What is critical thinking? You question. Is it right? Does it sound right? Does it seem right? This kind of questioning mind, that's critical thinking. Isn't that right? Basically, the basis of critical thinking is you get critical about something, right? So, is this right? I mean, does this make sense? Does it add up? Does it add up? Right? When you are dealing with these numbers, these don't just when you're dealing with all this data, graphs, right? When you look at the graph, you should be able to tell, is this something, does this graph tell something that makes sense or something that adds up? Or is it just, if you just pass it up, that must be okay, that must be right. I mean, otherwise, well, then you can be the victim of, misleading statistics, right? Misleading data, phony data, fake data, the data that is really phony, but just uh, uh, fabricated data that's just fabricated to mislead you, right? So you have to look at it with critical mind, with critical eyes, right? So, but then from think about it. If the last price means price at the last transaction, which is yesterday, obviously, or last, because in the print media, last price for the last price to be printed on the newspaper, it was yesterday's transaction, yesterday's trading. I mean, if this is a morning edition, morning paper, right? If this is evening edition, then it's possible it was at the end of the trading today, which is 4 p.m. as of 4 p.m. Right? Isn't that right? If this is the evening edition, I don't know. Even if I don't know if you have any concept of morning edition or evening edition, because you don't even read paper, print. You don't read newspaper, right? I mean, I don't read newspaper. I mean, I read newspaper online. I read New York Times and Wall Street Journal online, so it's almost real time, updated, almost constantly updated, right? We no longer. How many of you really read paper, right? Newspaper in print. How many of you? I don't think any of you read newspaper in print these days. But in the days when there was, really newspaper in print, there was morning edition and evening edition. And evening edition will have today's data from today's trading, and the latest trading, or the last trading ended at 4 p.m. So but the thing is, evening edition comes out almost, actually the time the evening edition comes out, that's almost like 4 o'clock, 4 p.m. Then for the evening edition to have the latest transaction data, then uh, the 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 data as of the market close of the day, that is not possible. It will have to be like previous day's closing or whatever. Morning edition can have yesterday's closing data, but then then the evening edition will still have yesterday's. And if it comes out at 4 p.m., But these days, it's online, so you see, last price is actually price as of the end of close at the close of the trading today. So yeah, once again, if you are a buyer, there's no need to complain. I mean, this is not a cause of complaint. Who's going to complain like 900% holding period return, right? But then, with a critical mind, I mean, is that realistic? What kind of bond? Think about it. Bond is what is a bond? It's a debt, right? So companies are borrowing from the bond market by selling bond. So if they are, so what? Then think about it. What kind of loan, right? What kind of debt pays 900% return over 10 years, over 6 years? Right? Does that make sense? Hmm? So if you have a
Yeah.
critical thinking, yeah, you're right. What kind of loan pays that? So if you have a critical mind, you will easily, instantaneously, you will see something's not right here. Well, why is the number like? So the answer is this price is not $91, but this price means actually $917.35. So then why didn't they put it like $917.35? Why didn't they do that? It is not dollar price, but it's the price expressed in percentage. Percentage of what? Percentage of the par value. Percentage of the face value 1,000. Okay, so because everyone knows that the face value of the bond is 1,000, all you need to do is times 91.735%, which is not difficult. It's 1,000, so $917.35. That's the price at the last trading. Okay, then that makes sense. That makes more sense. You pay $917, so 6 years later you will be paid $1,000. So your capital gains will be almost about $83, right? Your capital gains will be like $83. And then you receive, so that's the capital gains, and the cash flow, right? Cash flow, the interest, annually $70 for 6 years. So 7 times 6, right? So that would be like 420, isn't it right? And then you can find a holding period return that way. $80, almost $83 capital gains, and sum of all those coupons. 7 times right, 42, $420. So altogether, is capital gains plus cash flow, the interest income. Altogether, that's about $500, and you divide that by $917 that you paid for, and then it will give you still. That would be a very handsome, more than 50% holding period return. Does that make sense? Huh? But if you annualize it, and yield, what did I tell you? Yield means annualized return. Annualized. So if you annualize it, it comes to 8.83%. That was not a very good, that was not a very bad return, right? Even in 2010. Why? In 2010, think about it. In 2010, that was like 2 years after the financial crisis. So that was when the interest rates were very, very, very low. right? That was 2 years after financial crisis. So the Fed funds rate was like 0.25, and almost all, debt instruments like bonds, loans, and all the interest rates were very low. The days when interest rates were very low. And then in such a day, if they are paying 7% interest a year, and the yield almost 9% yield, that was a very good return. Now then, next, municipal bond. Treasury. Why is then Treasury? You might think, oh, so that must be 104.25%, and ask price is 104.26%. Of 1,000. So actually, the price is $1,040 and something. $42.50. No. Actually, it is percentage, but it's a little strange percentage. In other words, Treasury uses a weird system because in Treasury uses. Okay, I will just use the. I'll go back to. Where is it? I'll go back to this slide. Treasury uses actually 30-second system, 30-second, 32, 1/32, in other words. So, in other words, the decimals are not 1/100. Decimals are not 1/100, but the decimals are 1/32. You understand? So the bid is actually the bid price of 104. So that's why they use the colon there instead of decimal point colon. So 104:25 is 104%, 104 and 25/32 of 1%, right? 104 and 25/32 of 1%, 25 and 30, 25, 32nd, right? So this is why does the Treasury use such a weird system? But it's the Treasury convention. I mean, they have been doing it since, right? Since the beginning of the U.S. federal government, right? Since the Revolutionary War. I mean, once the U.S. Since the independence, right? Treasury Department has been, selling bonds and paid, interest, quoted interest this way, right? Quoted price this way. That's quite weird, but it still, in a way, it somehow it makes in the old. If you consider back in 18th century, 1776, right? 1776. The birth of U.S. independence, 1776. I still remember back in 1976, there was bicentennial of the U.S. independence, and there was a big sticker, like a bumper sticker, that was celebrating bicentennial, and I was in 76. I was like ninth grade, ninth grade, I think. Yeah. So I didn't have a car. Ninth grader doesn't have a car. So I put that bumper sticker on my Bible, King James Bible. So I still remember. But anyway, since the day one, U.S. government quoted, a Treasury Department quoted price this way. And in those days, of course, the par value was $1,000. I mean, even until 1960s, the par value wasn't 1,000. If you go back to, if you search, bond images, U.S. Treasury bond images, 1960s, the face value was $100 in those days, right? And then you think about it, quoting it by percentage, it's quite obvious. I mean, if in those days, if the face value was 100, right, 91 point something, 91.75 is exact percent is exactly $91, and but of course, times are different. When the Constitution was written, the founding fathers, when they this is going to be an endless debate, so I'm not going to get to it, because in those days, in the Constitution there was in amendments. One of the amendments, something like some penalty for land dispute, or penalty for in those days, the penalty was like, let's say you didn't pay the taxes for the land, or something like estate tax, or property tax for like 100 acres of land. If you didn't pay, the penalty was like $20. You might think, is that a penalty? I mean, isn't that a joke? By today's standard, it's a joke. But think about it. 1776, when the Constitution was written and amendments were added, in those 18 something, $20 was a huge amount of money. It's like a penalty of like $20,000 by today's standards. So what I'm saying is, we have to add some grain of salt, when we interpret the Constitution. And if there are people who are like Republicans, or especially the gun proponents, they always say because Second Amendment says this, well-regulated militia, blah blah blah, can bear arms, right to bear arms, blah blah. That was written in the Revolutionary War. Times were different. In those days, there was no formal armed forces. Then, so it was militia, and the militia had to arm themselves. Militia had to arm itself. So then that's why the Second Amendment is saying well-regulated militia. But
Professor,
nowadays,
I have a question. This is a little off topic for what you're talking about, but in the parentheses here, it says, for what the bid is, how to get the formula for the bid is 1,000 times 104.
No, 104%. Yeah, 104%. It's 1.04, and then it's percentage. So.
Yeah, is it multiplied by 25? Because there's no.
No. So consider it this way. You have to, in other words, so do it this way. Where's the calculator? I will. Okay, I will write on the thing. Canvas. So think about it. It's 1,000 times 1.04, right? Plus 0.04 1 times 25 over 32. In other words, it's 25 over 32 of 1. So you have to do it like this. Right. It's 25 over 32 of 1%. Make sense?
Okay, I got it.
Okay. 0.01 is, of course, 1%, right? So it's and think about it. In those days, they didn't have 18. Think about it, 18 something, 1805, right? 1776. You don't have calculator. You don't have well developed. I mean, in those days, people, if it is a fraction or decimal, they just either easily, what they can do is, this 1/8 system is easy because think about it. If you even these days, if you have in your car, if you have a car or gas tank, how is your fuel gauge in the dashboard? What does it look like? It looks like this, right? This is full, empty, right? And then half, 3/4, 1/4. You split it one more time. Split it one more time. What's it gonna be? 1/8, right? And then split it one more time. In other words, you split it like 2 to the -5th. You split it 5 times. 2 to the -5th. What's that? 1 over 32, isn't that right? So in around 1776, 1805, in those days, people found it easier to perceive the fraction this way, right? That's why they still use the quotation, that weird quotation like this. Okay, I think that's all the time we have. Okay, so I guess if you have any other questions, please email me. And so there is a midterm due Sunday. Just reminding you. So that's it for today. Have a great evening, everyone. And I will see you guys on Monday. Okay? All righty. So stop recording. All right. Take care, everyone.
Professor, I just have a quick question.
Yeah.
Is the midterm going to cover material on this week, or going to be starting from already from the beginning?
I told you it covers only 2 topics, financial statements and time value of money.
Okay, got you.
So it's like topic 2 and 3. Okay.
Okay, that makes sense.
Alrighty.
Thank you so much.
All right. Take care now.